SoFi just had another volatile trading day, and the real reasons behind it might surprise you. Hello, everyone. Welcome to Daily Stock Update. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell so you never miss any of our uploads and also enter our giveaway. But before that, alert, this is not a financial advice video. A major swing hit SoFi again, and understanding the forces behind this move requires looking deeper than just the price action. The stock closed roughly 2.8% lower after moving between a daily low near the mid-26 range and a high just under 28, with more than 75 million shares traded. At first glance, this may seem like a typical red day, influenced by broader market weakness, but the underlying cause was a strange combination of economic surprises, algorithmic pressure, and rising uncertainty across multiple fronts. The broader market came into the new week already carrying last week's fear. Much of this fear is being amplified by automated trading systems that instantly react to economic numbers, headlines, and rate cut expectations. Even though today wasn't supposed to be heavy with key data releases, one report caught the market off guard: the New York Empire State Manufacturing Index. Normally, this report barely moves markets. It usually lands close to forecasts and rarely brings any real shock value. But this time it reported a reading of 18.7 compared to the prior 10.7 and a forecast of just 7. Instead of dropping like the market expected, it came in extremely strong. And right now, the market hates big surprises, even positive ones, because strong economic data reduces the chances of rate cuts. This one number immediately lowered the probability of a December rate cut, dropping it to about 39.9%, while the likelihood of no cut jumped above 60%. Investors had been hoping for monetary relief and saw this week as a potential turning point, but this upside surprise killed momentum for any near-term policy easing. Along with that, geopolitical tensions added more fuel to the fear-based environment. Comments related to potential military involvement in foreign regions added uncertainty to an already sensitive market climate. The market currently wants a clean catalyst, something clear and supportive, and instead it received confusion, volatility, and disappearing rate cut hopes. Meanwhile, the upcoming FOMC minutes are expected midweek, which might provide more direction, but for now, traders are reacting to what they have. Institutional trading also played a role today. Some funds appear to be rotating positions, possibly for year-end tax strategies or portfolio rebalancing. SoFi itself did not release any major news today, but regulatory filings showed a couple of insider transactions. Around 23,000 shares sold by one executive and another 25,000 plus shares sold by a different officer. These were standard sales, not tax-related, and reflect insiders taking advantage of the post-earnings open selling window. Insiders are now free to trade after the blackout period, so some selling isn't unusual. Short interest also shifted slightly, increasing by around 68,000 shares. Short interest now sits near 95% of the free float, roughly 112 million shares. The cost to borrow remains unusually low, even negative at some brokers, indicating that brokers are encouraging more shorting activity. Despite that, shorts are not heavily increasing their positions. If bears believed a major downturn or recession was near, they would aggressively pile in, but that has not happened. Options flow was relatively light today, with around 51 million in call volume and 20 million in put volume, totaling about 71 million contracts. Around 46% of today's options were bearish. Bullish traders see SoFi holding in the high 20s range, while bearish sentiment expects a dip toward the low 20s. Some of this caution is linked to major earnings ahead, including Nvidia and Walmart, along with the FOMC minutes, which could spark additional volatility. On the secondary market, most of today's larger trades came from institutions reducing positions rather than accumulating. Some of the larger trades included blocks in the 40 million, 11 million, 8 million, and 7 million share ranges. The dark pool also saw activity, but nothing unusually large, mostly blocks ranging from 5-6 million down to smaller sizes. No massive dip buying yet from institutions, which indicates many large players are waiting for clarity. Technically, SoFi is trading around the mid-27 range, sandwiched between a pivot level and the S1 support zone. The 2666 level is a key near-term support to watch heading into tomorrow. If selling accelerates, the next major support sits closer to the 2520 range. Tomorrow's early ADP employment reading could be another trigger for volatility, especially since last week's ADP data caused a noticeable market reaction by coming in much stronger than expected. From a technical standpoint, one of the most important developments is that SoFi has now closed 2 consecutive sessions below the 50-day moving average. Historically, when this has happened, like earlier in February, it has sometimes led to extended consolidation or deeper pullbacks. In theory, if this pattern repeats, SoFi could face an additional 20 to 30% downward range before stabilizing. This is not guaranteed, but the technical signal is worth watching. One concern is that much of the recent downward pressure feels artificial, driven more by algorithms reacting to macro indicators rather than fundamental weakness in SoFi's business. This is why the drop may feel exaggerated compared to what the company itself is doing operationally. No new analyst ratings came out today, and there were no dedicated articles targeting SoFi specifically. The stock is simply moving with the broader market's uncertainty and reacting to economic surprises. Overall, today's decline was not caused by company-related issues, but by a combination of unexpected strong economic data, decreased rate cut expectations, institutional repositioning, algorithmic trading pressure, geopolitical noise, and a temporarily weakened technical setup. As major data points approach midweek, volatility may continue, especially with so much of the trading landscape being driven by macro factors instead of fundamentals. Friends, that's all we have for you today. What is your opinion about today's video? Get involved and let us know in the comments down below. Thanks for watching.